Assalamualaikum and a very good day I bid to Madam Nadia Farlina Muhammad Aznan and fellow viewers. I am Nur Adila Natasha binti Chamit from BA2424B, and today I would like to explain about the comparison of conventional and Islamic financing systems. So let's look at the definition first. Islamic finance refers to how businesses and individuals raise capital in accordance with Sharia or Islamic law. It also refers to the types of investments that are permissible under this form of law, while the conventional finance is a transaction based on interest rate for savings, surplus, or deficit spending units to loan or borrow funds in financial markets. The next one is value proposition in Islamic financing. Firstly, it assists in financial inclusion. The conventional banking system is based on paying interest at a predetermined rate on deposits of money. As both payment and receipt of interest is prohibited by the Sharia law, Muslims generally abstain from banking. Through Islamic banking, financial inclusion can be promoted and a larger pool of savings can be brought into the economy. Next, reducing the impact of harmful products and practices. Sharia principles forbid any investment that would support industries or activities that are considered harmful to the people and the society in general. This includes usury, speculation and gambling, irrespective of whether these are legal or not in each territory. Next, it promotes the principle of financial justice. Financial justice is a basic requirement for the functioning of Islamic finance products. Western or conventional financing looks forward to profit through interest payments and makes the beneficiary completely liable for any risk. Contrary to this, Islamic financing paves way for the sharing of net profit or loss and the risk involved in a proportional manner between the lender and the beneficiary. Therefore, if a financier is expecting a claim on profits of a project, it is necessary that he should also carry a proportional share of the loss of that project. Next, encouraging stability in investment. In Islamic finance, investments are approached with a slower, insightful decision-making process when compared to conventional finance. Companies whose financial practices and operations are too risky are usually kept away by Islamic financing companies. By performing intensive audits and analysis, Islamic finance promotes the reduction of risk and creates the space for a greater investment stability. And the last one is accelerating economic development. Islamic finance companies certainly have profit creation and growth as their objective, for which they choose to invest in businesses based on their potential for growth and success. Thus, in the Islamic banking industry, each bank will invest in promising business ventures and attempt to outperform its competitors in order to attract more funds from its depositors. This will eventually result in high returns on investment both for the bank and the depositors. This is unlikely in a conventional bank, where depositors redeem returns on their deposits based on a predetermined interest rate. Next is value proposition of conventional financing. As mentioned earlier, there are restrictions to Islamic financing when it comes to the halal source of income. As an advantage, it does not apply to conventional banking products. If you happen to own a string of legal gambling lottery ticket businesses, you will be allowed to apply for conventional banking products as long as you are able to provide the necessary income documents. Also, with conventional mortgages, if an individual wishes to increase the loan amount on a property, there would only be an additional stamp fee levied without having to draw up a new agreement. On the other hand, if you used Islamic-based mortgage to finance your property, increasing the loan amount would require you to make a new buy and sell agreement. In a conventional mortgage, this could lead to more savings if such a situation were to arise. For operational mechanism, since Islamic banking had grown owing to the global financial crunch, it will be important to establish the difference of both Islamic banking and conventional banking. Very few people who know the real difference between Islamic and conventional banking, as apparently both seem the same, as in conventional banking interest is charged on each transaction, and on the other hand, Islamic banking is based on interest-free banking, but they also charge some fees for their transactions. Many employees, even in the Islamic banks, do not know the basic concept or rationale behind Islamic modes of financing. Islamic banking is asset-based banking, which means that its transactions must be backed by some asset. Interest or riba is prohibited in Islam, therefore it is also prohibited in Islamic banking operations. On the other hand, conventional banking is totally based on interest. They charge interest on their transactions and take out profit from that. In conventional banking, only the profit is shared, whereas in Islamic banking, profit and loss both are shared. Islamic banking must stay within the limits of Islamic law and Sharia in all actions and transactions. Islamic banking is done by laws and regulations which are defined in the Quran and Sunnah, in which the product or services are not introduced by the Islamic banks which contradict the Islamic values. These banks also introduce tax and zakat system according to the Islamic values. Profit sharing is fixed in Islamic banking based on real profit. Islamic banks based on the buyer-seller relationship, whereas conventional banking based on the debtor-creditor relationship. The regulations, laws, rules, and transactions of conventional banking system are fully man-made. Investors are encouraged by maximum interest rate. The aim of conventional banking system is to earn profit. In case of any default by the investor, it charges extra amount of money, whereas in Islamic banking, in case of default, the extra amount charged to customer will go for charity but not in the bank's income. Conventional banks always encourage providing loans with fixed interest rates for each customer, which is against our Islamic values. The accounting and auditing for both banking systems is to some extent similar, but the documentation in Islamic banking is different as compared to conventional banking. If a person wants to start his businesses, he will take a loan on interest basis from a conventional bank and pay the principal amount plus the interest on that. On the other hand, if the same person goes to Islamic bank, the Islamic bank asks him about the type of business he wants to start and provide all resources or material to him to start his business instead of giving him only cash and charge some fees on that. Now, many conventional banks also open Islamic banking window or move toward Islamic banking due to change in the trend of banking. So, Islamic banking is relatively better from conventional banking because it follows all the Islamic values and conditions which are given in the Quran and Sunnah. The most common instrument offered in Islamic finance is murabaha financing. Murabaha financing can be used for short-term investment and also can be used for long-term investment. Murabaha is like a markup instrument available in Islamic finance. It is cost plus profit financing for asset acquisition. It is sale contract through which bank sells goods to its customer on profit revealing the original cost and profit charged in the contract. The other instrument is suku as-salam, which is asset-backed security, and it is used for liquidity management in Islamic banking system. It is an Islamic investment certificate or note which is parallel to yield bond of conventional banks and have the same motive of liquidity and tradability. There are many types of sukuk, which is based on Sharia complements such as buy vitamin ajil, musyarakah, ijarah, mudarbah, istisna, murabahah, and salam. Wakalah is another important instrument used for liquidity management in Islamic financial system. According to Ismail, wakalah is an agency contract in which one party appoints the other party as an agent, which is wakil. by paying certain service charges against the task performed by the agent on the behalf of the investor, which is muwakil. It is service provision contract. There are many types of wakalah like wakalah in purchase, wakalah in sale, absolute agency or also called unrestricted wakalah, restricted wakalah, general wakalah, and special wakalah. But two major types of wakalah are restricted and unrestricted wakalah. And the last one is ijarah financing. Ijarah financing is also a very important tool for financing Islamic banking system. Islamic bank allows the customer to use the asset against fixed charges which is paid by the customer to bank. In conventional banking system, there are many types of financial instruments offered. Bills of exchange and other commercial papers are financial instruments which are used in conventional banking for liquidity management as an instrument of debt financing. Conventional banks also use receivables, either account receivables or note receivables, for liquidity management. Customer deposits are the other source of liquidity management in banking system. Lastly, long-term and intermediate-term bonds are also used as financial instruments for debt financing. In conclusion, both types of financial systems have their own different types of advantages and financial instruments. From the discussion, it is clear that Islamic financial system has more equity-based instrument than conventional system and promotes equity-based instrument rather than debt-based instruments. Islamic finance has very much potential to compete with the conventional around the globe. Also, Islamic financial institutions will give more tough time to conventional financial institutions in terms of competition around the world. It may take more time for development, but it will be a more beneficial system for the society around the globe. I think that is all from me. Thank you for lending me your ears.